Great. So today we are going to look at the continuation of the adjustments. So a quick reminder or a quick review. We said that the footnote that we are going to look after or the additional information that they will give it to us in the question will comprise of the following. One, made up of one, adjustment. And then some of the footnotes will be what? Adjustments. In adjustment, we have A, we have B, and we have C. We look at the bad debt, accruals, and prepayments. So some of the adjustments will talk about accruals. Some of the adjustments will talk about what? Prepayments. And then finally, we will consider bad debt and provisions for bad debt. So these are the items that will form part of the adjustments. And we say two, errors or mistakes in the account. Finally, we said that you can also come across what the IFRS is, the financial reporting standard. So the footnote that we are going to meet in the exams, this is where we are going to pick it from. So we have to familiar ourselves. And last week we did up to accruals and prepayment. So if I've not gone through, humble suggestion will be right after today's section, go through those ones and then you'll be fine. So today we will continue from bad debt and provision for bad debts and then clear errors and we start our first standard IFRS. But last week, before we end the program, said that there will be IAS2 video on IAS2 so that you go through them for me before today. So I believe strongly that everyone have done that. So we will get there. Good. So today we are going to look at the bad debts and provision for bad debts, how it must be accounted for in the books, bad debts and provision for bad debts. So when they are in the question, how do you treat them? That is the today's section. That is the today's section. Great. Now let's start the game. Now when you talk about bad debts, what are bad debts? Debt which is bad, eh? Yes. Debt which has what? One bad. So let's start with the bad debt first. Bad debt. So bad debt simple means debt that cannot be what? Recovered or received or recouped due to the following reasons: bankruptcy, death, or the customer can run away from the country. Yes. So assume that giving some sums of money out as probably advance or facility, about 20,000 Ghana cedis. It's going to three people. So a person who took 5,000 that decided to run away from the country, you cannot trace this particular person. So it means that whatever that person is owing you for now is a bad debt. You can't recover it. Why? Because you don't know where the person is. No insurance. The debt wasn't insured. Good. Or even the person have decided to die. Yes. You commit suicide. Unless you too, you kill yourself and then follow him to the grave to go and take your 5,000 and come back. if it will be possible. Then a competent court can declare that person a bankrupt. That means you can't go and take your money from him. So these are the circumstances that will cause what? A debt to be what? Bad. So that's the bad debt. Now, the causes of bad debt is not the central focus. We are what? Financial accountants or we are reporters. So it will happen. So what do we do? How do we report it in the books? That's the central focus. So the accounting treatment is the what? The central focus. So not the causes. What caused bad debt? No, not at all. So the accounting treatment of bad debt. How do you treat bad debt in the books? So bad debt is a debt that you assume that or you cannot what recover or received. Good. Now what's the accounting treatment? So accounting treatment of bad debt is that so bad debt is an expense which must be what? Written off. So true treatment. Bad debt is an expense, but the treatment depends on where you meet it. So let's assume that it's in a trial balance. If bad debt is in a trial balance, then it is an expense. It ends there. So it must be expensed in the P&L. Preferably, it must be treated in what? Operating expenses. So you add it to what? Operating expenses. That's the reason what? The trial balance. Good. That's is in a trial balance. What if it's in a footnote? If it's in additional information, we call it a bad debt which has not been what? Written off. So what's the treatment? Two. First, it's an expense. Second, it must be written off. In fact, we have to write it off first. So it must be written off. How do you write debt off? Like the example that I gave. You have given a facility to people, three different customers, totaling 20,000 cities. So that 20,000 cities, there's a particular customer who decided to take his life off. And now he was owing you 5,000 cities. So first, what do you do? That means you have to write it off against the total receivable. How do you do the written off? So it means that I have to subtract it from the pool of debt or pool of the facility I've given out. Then it will give me what? The remaining balance. Because I can only what? Receive 15,000. So I will receive 15,000. So therefore, written off simple means subtract. Subtract from where? From the receivable or the debtor's figure. That's the first treatment. So treatment A and then treatment B. B, add it to operating expenses. Add it to operating expenses. That's the usual treatment. Yeah. So it means that when you see bad debt in the trial balance, it has been written what off already. That is the indication. If you see bad debt in a trial balance, it has been what? Written off already. So that one, you don't write it off again. You have to do what? Expense it. So we are done with what? Bad debt. Now, let's look at the other section. We have what you call provision for bad debt. So now we are now going to look at provision for bad debt. There are slight difference between bad debt and provision for what? Bad debt. Bad debt, you are certain, you are sure that this money you are not going to receive it. Why? but the customer has what passed on, and there's no insurance, and no family member is ready to pay that loan. But it was investments. You see that either the head of the family will come and sign and then do what? Take that investment away. But for loan, if you go there, say, oh, in fact, our member didn't give us anything to pay the loan. Good. So that is it. Now, provision for bad debts or provision for bad and doubtful debts. The provision comes in when that one is not certain, it has not occurred, the customer has not died yet, but you suspect that this customer will die, or you suspect that this customer will not bring the money, or you suspect that this money I may not be able to receive all. I may not be able to receive all. I'm sure that about 5% of the money will go waste. I'll not receive it. How do you get it? So that one is an estimate. You are estimating the likelihood of the proportion of the amount that you are not going to receive. That is provision for bad debt. But bad debt there, it has already occurred. The customer has died. So that one, the money, you've lost it. Put it in a manner that is permanent loss. But the provision, so as soon as you give the money to the customer, start making provisions that this customer 50-50. Despite the collateral, despite the insurance, he might not be able to pay all the amount. So that's the difference. So provision is an anticipated amount of the receivable, part of the receivable, which might not be what be received. Good. So the issue is this: we have to know how to account for this in the books, in the financial statement. So how we have to account for it. So that is the question. So now let's see. So provision for bad debt. Provision for bad debt. So provision for bad debt. We also call it doubtful debt. Provision for doubtful debt. So provision for doubtful debt. Now that one, in fact, it's one thing that we have to do. You have to relax. All provision, you compare open balances to that of the closing balance. Any movement must be sent to what? Operating expenses. We are done. So the underlying word is compare balances. What is the open balance of the provision made and what's the closing balance? You are done. So let's see. So open balance. So you record open balance so much. Your Ghana city will be here. Then you leave one line. You come and record closing balance. So much. Closing balance so much. Then you compare the open balance to that of the closing balance. The movement is what? Is what you have to expense. So therefore, the balancing figure, the difference between this open balance and this closing balance comes here as well. You write P&L. Preferably, it must go to operating expenses, the movement. That is the provision for bad debt. Now the question is, how do you get this figure, the open balance? It will be given to you in a trial balance if it's in a question. Then the closing balance will not be given to you. So you go and look for it. How to get a closing balance, and then you are fine. Okay. Now let's perform this exercise. Aside you sending the movement to the closing balance, movement to the operating expenses, this closing balance must be subtracted from the receivable, from the trade receivable, trade what receivable, in what statement of financial position. Good. I hope you get it. Great. So always the closing balance of the provision for bad debt must be subtracted. We will pick an illustration and then we familiar ourselves with it. Good. So the closing balance of the provision for bad debt must be subtracted from the receivable. The final figure enters the financial position. Good. So that is it. Now, what if the opening balance is 50 Ghana cedis and the closing balance is what? 60. What will happen here? Just an example. Assuming that the opening balance is 50 and the closing balance is what? 60. Then the movement will be what? 10 positive. That means when I go to my operating expenses, when I'm calculating my operating expenses here, operating expenses, I'll tell the examiner that increase in provision or just provision for bad debt, I write what? 10 years. How we get it? Good. Coming from workings number, so much. Put it there. Good. Now, and then this closing balance, we go and subtract it from the receivable. We are done. So that's how it will be. Now let's look at the, what if here is 45? What do you think will happen? If here is 45, if the closing balance is what? 45, then if the closing balance is 45, then the difference will be what? 5 Ghana cedis. Will I add? What should I do to the opening balance of 50 so that I can get the closing balance of 45? The meaning I have to do what? I have to subtract. So that is it. As is negative here, so as when I come here, I record it at what? At 5. That is it. How we get it. So if I reduce it, I have to reduce it. This interpretation, at the start of the year, you've already made a provision of 50 Ghana cedis there to cater for any anticipated loss. You've given so many, or you've given so many people facility, or you've given a lot of funds out. So at the start of the year, you've made a provision of 50 Ghana cedis. And then getting to the end of the year, according to your assessment, you realize that only 45 you are going to lose. So that means the gain for you. Meanwhile, you already have 50. So that means I have to reduce whatever provision I have there because it's too much. I don't need 50, I need 45. So indirectly, the gain is a plus for you. So when it comes to operating expenses, come and subtract from your expenses because you are gaining. Why? Because last year you make a provision more than this year's requirements. That's why when it was 50 and then 60, you are adding what? 10 to it. Why? Because at the start of the year, you have what? You have 50 Ghana cedis there. But at the end, you need 60. Then come and top it up. Additional provision must be made by what? Bringing a 10 here as what? As an expense. How we get it? So that is the idea behind. So now we are going to look for several ways of getting these 45 and 60. That's the closing balance. That's the only issue. The open balance, don't worry yourself, it will be given to you in the trial balance. Now, what matters is the closing balance that we have to go and look at for. That is it. Good. So, now before that, what if the open balance? Now, this one that you are trying it for me. What if the open balance is not given dash, but the closing balance is 30? What will happen? We call this one first time of provision. It was your first time First I'm giving facility out, and first I'm making provision. So the closing balance is 30, open balance nothing. So what do we do? So the store, you shouldn't change the rule. The rule says that what should I add to this figure so that I can get this? For us to add what 30, the year will be 30. When I come here, I come and record what 30 here. I will get it. Then this one goes my statement of financial position. I'll go and subtract it from where? Whatever amount I've given it out. So if I've given, let's say, 500 Ghana out, so when I go, I'll take 30 Ghana cedis from 500 because I strongly suspect that 30 Ghana cedis, I will not receive it. 30 Ghana cedis of 500 Ghana, I will not receive it. So in my financial position, if I write the amount that I'll be receiving, that's the trade receivable, I will tell the examiner that it will be 500 Ghana less any provision, which is the closing balance, making what 30. So here we got 400 and what 70 Ghana cedis. How we get it? 470 Ghana cedis. So this is how we are going to what record it in the books. So let me go over again. First, you get the opening balance from the trial balance. So this is given the trial balance. If it's not in the trial balance, it's not given. We shouldn't assume any figure, it's not given. Then we have to go for the closing balance. It will be given to you in a footnote in the form of statement, and you have to deduce the figure from it. So now you're going to look at the various ways that the examiner will give you. So now let's see the various way that it is stated. Good. Then after getting the closing balance, you compare to the opening. Then any movement must be reported in the operating expenses in the P&L. We are done. So now let's look out for the ways in which this closing balance will be given to us. Or in a situation where they don't give the closing balance, the examiner may give you this. That's the movement. That means you have to find the closing balance yourself. Great. So that is it. So now I'll give you three specific statements that if you want to use the provision for bad debt, how it will be stated for you, and then that's all. How it will be stated for you, and then you are done. Now let's see. So let's look at those statements. So statement number one. Statement number one. All of them will start like this. The bad and the doubtful debt provision. All the statements, the examiner will start by saying something like this. The bad and doubtful debt provision should be, then you stop. Come and use the three issues. So one should be adjusted, to or equal to, adjusted or equal to, so adjusted or equal to a certain percentage. So let's say 10%, 8% of the trade receivable. Very important. Trade receivable. Full stop. That's the first statement. All of the situation, I will give all what you need. Then we start the calculation. Then the second statement, they will tell you that Still, to start, the bad and doubtful debt provision should be so it should be reduced by reduced by 10%. We are done. Then finally, the bad and the doubtful debt provision should be increased should be increased to should be increased to 15% of trade receivable. You are done. So these are a few illustrations that you may see them in the exams concerning the closing balance, how to arrive at the closing balance. So we are going to pick each of them and then do justice with it. Now we are going to assume that in a trial balance, the bad debt figure is this. So let's assume this figure. So let's assume that the bad debt, the open balance of the provision for bad debt in a trial balance. The open balance is, we are just assuming that it is what, 5,000 cedis. And then the trade receivable figure given to us in the trial balance. Let's just assume that it is what is 20,000. 20,000, okay, yes. So it's 20,000. Great. So that is it. Good. So kindly take notes of the question, and because I will task this section to pick it up. So now let's take them one after the other. So first, all what we are looking for is the closing balance. Good. So here we are going to prepare extracts. How will the how will the financial statement, the P&L, and then the financial position, the balance sheet will look like? Good. So let's see. So the first one says the provision for bad and doubtful debt, bad and doubtful debt should be adjusted to 8% of trade receivable. Should be adjusted. So the question is adjusted to 8% of what? Trade receivable. That's the line word. So that means the closing balance is nothing by 8% of the trade receivable. So whatever facility you have given out to the customers, strike 8% of it. You're not going to receive it. That is your analysis. So whatever amount you are giving to your customers, strike what? Strike 8% of it. You're not going to receive it. How we get it? Good. So that will be the closing balance. That's all. So let me work on that one now. So I will come and pick the second ones. Don't worry. I'll record all of them for you. I'll record all of them for you. So first you tell me the workings. You tell me the provision for bad debt account, how it will look like. The provision for bad debt accounts. So first, the more I remember, the more I write, the more I remember. So the open balance. We were told that the open balance is what? 5,000. For Ghana city. 5,000. Closing balance. They're not given to me. So I'll go and calculate it. How do I calculate? They said it must be adjusted equal to 8% of what trade receivable. What's the trade receivable? 20,000. So 8% of trade receivable is what? 8% of trade receivable. 8% of trade receivable. So 8% will be 2,600 agreed. Good. So I tell the examiner that the closing balance is 8% times what? 20,000. So I'll put the answer in here, 2,600. Good. I hope you get it. Okay. It's 1,006, right? Okay. So that's 1,600. Great. So 1,600. I like that. Okay. So that's 1,600. 1,600. Great. Then you compare. So let's do the comparison. Open balance is 5,000. What should I do to this open balance before I arrive at what? 1,600. Good. Okay. So you compare. So what's the movement? So what should I do to 5,000? So that at the end of the day, I'll get 1,600. So it means that the movement is what? So I write here P&L. To be precise, if you go to where? Operating expenses. I'm done. Because there are so many parts of what P&L. Tell us exact place or send it to an exact place. You are done. So what's the movement? Any idea? 3,400. Will I add or I'll subtract? I have to subtract. Good news. So something like this. Then I'm done with the workings. This is workings that we have to do. That statement will be in a footnote. And then what we have there will be on what? The trial balance. So what we do is this. Now let's prepare the extract, how the P&L will look like. So first, the operating expenses, how it will look like. And then the financial position, that's the balance sheet, how the balance sheet will look like. Extracts. Good. And now we know the operating expenses, we know the financial position because we've gone through the first stage of it. Good. So we have recorded here provision for bad debt. Then I'll put my currency here. What's the movement? 3,400. So I write 3,400 here and then I'll subtract it. I'll put in bracket. As it is here, just carry it here. If you like, tell the examiner that yes, you are aware. We call this one decrease in provision. The provision has what? Decrease. It's a gain to you. So that's why we are netting it off against the expenses. It's a gain. Because the provision has what? Gone down. Meanwhile, if you make a huge provision of 5,000 there, but actually only 1,006, you're not going to receive. Good. Now let's go to the financial position. When you go to the financial position, what do? In the right trade receivable, we said that whatever be the closing balance, you have to take it off from where? The facility, the pool of debt that you have. So therefore, my trade receivable will be my trade receivable will be into brackets the 20,000 less the closing balance of what? 1,600. The closing balance of 1,600. So therefore, you get something like 18,400. So 18,000, but let's all be in the same line, 18,400. So this is how the financial position will look like. We are done for the first phase. Then I'll look out for the second phase. When I'm done, I'll do a remiss. Then we are done with the provision for bad and doubtful debts. I'll be got it. Good. So that is it. And you'll be fine. Great. Okay. Now let's look at the second statement. Because if I do one, you do one. I will project, after I've gone through all these three series, I'll project a question and then you start working on it for me. Good. So the second one says that the provision for bad and doubtful debt must be what? Reduced by what? 10%. Must be reduced by 10%. Yeah, and the line where there is reduced by, in fact, the by, let me make it capital letters. It must be reduced by, underline the word by, and then the 10%. Now, this is the interpretation to this style. The provision is 5,000. It has reduced to, this guy is 2,600. Or the same question, the provision has reduced by 3,400. That is the interpretation. So in short, the P&L, what goes to the P&L is the buy, or that's the movement. What goes to the financial position is the two, or that's the closing balance. How we get it? Good. So if this note is telling us that the provision for bad and doubtful debt must be reduced by 10%. They didn't say 10% of trade receivable, no, they said 10%. And 10% is 10%. Good. So how are you going to do it? So that is it. So I'll dash the board and now clean all these ones. Still, the open balance will not change. And yet they are saying that the provision must be reduced by 10%. So what is the provision? Who can tell me the provision? Which of the provision are you going to reduce by 10%? Which of the provision? No, the provision is what? 5,000. So that 5,000 must be reduced by what? 10%. How big get it? So the 5,000 must be what? Reduced by 10%. So find 10% of this 5,000. So that will give us something like, in the bracket, 5% times what? 5,000. Is it 10%? Sorry, okay. Good. 10% of 5,000. And that will give us 500. And once they say it must be reduced, we add or we will subtract it. Good. So we have to what? Subtract it because they say it must be reduced. So have you seen that here? We are rather finding the P&L item, the movement, because by is the movement. Then the closing balance, when we subtracted or after the subtraction, what you get? You get 4,500. We are done. This is where it is. If you do this, you're not done with the game. Show the relevant extracts. So P&L, I'll go there and record 500. I'll put it in brackets because here it's in brackets. I record it here. This will go to the financial position. Take it off. Now, when we're doing just the trial balance, you realize that we said we have to subtract the provision from the trade receivable. Now, the right provision that we have to subtract is the closing balance, not the open balance that we are subtracting. Yes, because we are doing that because we are not tackling the footnote. Now we are tackling the footnote. So things will change. Adjustment will come in. How we get it? Good. So when I come here, I record 20,000 less 4,500. And now give us 15,500. We are done. Good. Now, if I do one, you do one to one mapping, one to one mapping. Now let's make some small changes. This 15%, it must be 30%. That's all. Then you are doing it for me. So the last illustration, we said that the bad and doubtful debt provision must be increased to, they said it must be increased to 30% of the trade receivable. So you try that one for me. But before that, what if here they say we should increase it by 10%? Oh, increase by 10%. Then all what you have to do is that one we will add. Increase by 10%. We will do what? Add. And then we get what? 5,500. Here will be what? Positive 500. Here we less what? 5,005. That will give us 14,500. How we get it? Good. So that is the game. Okay. What if they say reduce by 10% of trade receivable? What if I add of trade receivable there? Have you seen what you are doing? You are going to meet one exact in the exam. I don't know the one they are going to meet in exams. So that's why we are trying several alternatives. And definitely one of them will be there in your exam. Good. So if they add of trade receivable, then it means that this 10% will not be strike on this figure. It must be strike on what? The trade receivable, which is what? The 20,000. So it will be 10% of 20,000. That's what? 2,000. And I will place it here because they say of what? Trade receivable. That is 2019 April. That was the statement. And I'll project that one too and do justice. All of them will do them today for how to familiarize ourselves. So I'm done with my section. At least I've done two. Then you are doing one. You are the game or the rule for the mapping was what? One to one. But now it's two to one. Good. So you are trying this for me. You are trying this. Assume that the burden that's for the provision must be increased to 30% of the trade receivable. How would that one be? So let's try. Great. So we will have something like first. Let's still the template will be there. So the opening balance will still be there, closing balance is there. So now let's read. They say the bad and the doubtful debt provision must be adjusted to 30% of trade receivable. Okay, so that means the closing balance is nothing but 30% of what? Trade receivable. We are done. So the increase to. Okay, then what about the increase by? I like that. I like that. Wow. Third answer received. So 30% to that of what? The receivable. It must increase to. Here's the two. Two means it must come here. Increase. Increase means the answer that you get it will be more than 5,000. That's the thing. And truth is more than 5,000, so that's increase. The provision has what? Increase. Good. If they have stated this way, adjusted to, That one they didn't say increase or decrease, so that one just put it there. Or they can also say decrease it to 20% of the receivable. So decrease to 20%. So it can also be said decrease to 20%. So you find 20% of the receivable making 4,000. It has decreased as compared to 5,000. Good. Thank you. So you open your bracket and do the workings here. 30% times 20,000. As someone did it for me nicely. That will give us 6,000. Then you double underline it. Because they say two, it must be the closing balance. If they should have said by, is the movement. Then you relax for a while. Then you come back. You compare the movement. So here it has increased by what? 1,000 Ghana cedis. Then you are done. This is the workings. Please, these are the aspects that I want you to score for me in the exams, not the IFRSs. Good. Now, let's prepare the extract. So here, this go to the operating expenses. So I'll put 1,000 here. In my trade receivable, I bring the balance, which is 20,000, and less what? 6,000 from it. Then that's the end of the game. I'll get what? 14,000. And that's the end of the game. Left one more item, then I'm done with what? Then I'm done with the provision for bad debt. So that's how the question will be. Now let me add one last item finally to it. What if there was bad debt in a footnote? I'm using the same question. If you look at it, if there was bad debt in a footnote, who can tell me the treatment? If you are ready, let me know. We will omit the microphone for you to voice it out. What's the treatment if bad debt is in a footnote? How do you treat it? Good. So first, any bad debt in a footnote must be what? Written off first. How do you write debt off? It means that subtract it from where the trade receivable. That's the end of the game. So let's assume that this is our trial balance. This is the trial balance, extra from the trial balance. And then in the footnote, note 1 states that after the year end, one of the customers was declared bankrupt due to difficulties in trading conditions. And that customer was owing us 2,000 Ghana cedis. So the customer owing 2,000 has been declared bankrupt. So that means this 2,000 has not been written off. We have to write it off because it's what is in a footnote. That's the first treatment. How do you write the debt off? So first, we said that it must be subtracted from where? The trade receivable first. So I'll do that one here. Great. Great. So how do you treat it? So first, now let me touch the board. So the temperature remain unaltered, still the same. It's fixed. So first, my first workings, I have to write that customer's debt off. So I tell the examiner that workings number one, the bad debt must be written off first. The bad debt must be written off. So bad debt written off. Bad debt written off. Good. How do I do that? Don't worry, bring the trade receivable. So trade receivable, what's the trade receivable? 20,000. So 20,000 less that customer who has been declared what? Bankrupt. So 2,000. So that would be 18,000, right? Good. So it means that anytime I need trade receivable is 18,000, not the 20,000 stated in the question. So anytime you need what? Trade receivable, which is what? 18,000, not the 20,000. Because a certain amount has not been yet accounted for. And now you have what? Account for it. So that is it. Second, we said that after you write it off, all the items in the footnote, the one on their own, treat them two times. How we get it? Good. So therefore, 2,000. So you go to operating expense now, record bad debt written off. So I write here bad debt, then I'll put 2,000 here. I'm done. So first, if bad debt is in the footnote, subtract it from the trade receivable. Second, add it to operating expenses. It ends there. So that's the first treatment. Then let's go to the provision. Let's go to the provision. Let us know that we are using the first statement. What was the first statement? We are using the first. We gave three statements. So the first one is bad and doubtful debt should be adjusted to 8% of the receivable. Eh? Okay. Can we change things? Okay, let me change it. Now, note 2. Bad and doubtful debt provision must be increased by 10% of the trade receivable. Bad and doubtful debt provision must be increased by 10% of trade receivable. I hope you get it. Let me repeat. Bad and doubtful debt provision must be increased by 10% of what? Trade receivable. Full stop. How do you treat it? Now, anytime there was bad debt in a footnote, the examiner will let you calculate the provision for bad debt on the receivable so that to test and see whether you're going to calculate it on the 20,000 or on the 18,000. That's the game. So, they're saying that the bad and doubtful debt provision must be adjusted to or increased to or increased by, or here they say, oh, it's increased by 10% of what? Trade receivable. So increase by, it means that's the movement, right? That's the P&L here. So open your bracket, increase by 10%. So find 10% of what? The trade receivable. Now what's the trade receivable? Will it be the 20,000 or the 18,000? Which is which? Good. It must be what? The 18,000. Good. So in short, before you make any provision, all bad debt must be written off first. That's the accounting principle. Before any provision should be made, all bad debt must be what? Written off first. This one is practical. You have given someone money, 20,000 out, and then they've informed you that 2,000 have been wasted or it has been scrapped off, or the person has like run away with 2,000. And now you are estimating the likelihood of amount that you're not going to receive. Are you going to estimate on the overall amount or the amount left? It must be the amount left because you are sure that that 2,000 there is gone. So left be 18. So any provision must be estimated on the remaining balance. Good. So that is it. And here we are estimating it on 18,000 because the examiner said it must be increased by 10% of what? 10% of trade receivable. The line word is what? Trade receivable. It's because the examiner said 10% of trade receivable. That's why we are doing that. Good. So therefore, what do we do? 10% of what? 18,000 will give us 1,800. They say we should increase it. Increase means add. So therefore, this plus this will give us 6,800. Have you seen how the game is? This is the ending section, and it look like it's a bit sleepy. Good. So therefore, the movement will be what? 1,800 positive because that's increased, and then the trade receivable to subtract what? So trade receivable now here to not be 20,000 to be what? 18,000 less what? The 6,800. Agreed. 18,000 less 600. 6,800 because now the trade receivable is 18,000 because the phone working is here. Or if you don't want trouble too, you can tell us okay it's 20,000 less the 2,000. Now less the 6,800. Agreed. You can also do this way because original trade receivable taking off 2,000 and then you take off the 6,800 from it. So finally the trade receivable figure will be what? That will be 12,000 or 11,200. So 11,200. And that is the answer. And that's the end of the game. So as usual, if there's any question, kindly let me know. If there are no questions too, we will resume the game. That's if I do one, you do one. So we just 2 minutes to try one here. Good. So that is it. Okay, now try this for me. Question number 3. Let's go to question 3. So question 3. Question 3. So question 3, yes, input use here. So we will scan through the trial balance and see if there's provision for bad debt in the trial balance. Good, here is it. So we're picking the items that we need. We need only two items. The provision for bad debt and then the debtors figure. So these two items, the provision and then the debtors figure. So the provision is what? 200. That's the open balance. And then the trade debtors is what? 6,000. So debtors and receivable means the same. So here is what? 6,000. So that's the items that we need from this trial balance. So still the presentation will not change. The extract got to go to operating expenses, the financial position, and then the workings. Then you send them here. That one will not change. I hope you get that. Good. Now let's see. Good. Now let's continue the game. Let's go to the footnote. Now note 4. So we're going to consider note 4. Note 4. So we are considering note 4. Only note 4. That's all. So what are they saying? Note 4. They are saying bad debts of 0.8 million is to be written off. Wow. Okay, so that means we have to write it off. Oh. Okay, and now we know how to write debt off. Good. Second, the doubtful debt provision is to be made equal to 5% of debtors. That's the first statement. Is to be adjusted to or equal to 5% of debtors as at 31st December 2018. Good. So that is it. So now let's try. So if you need any figure, let me go back to the trial balance. Kindly pick all all the figures that you need from the trial balance. So I'll go there again. When I go, kindly pick only two figures you need for now. You need the provision for bad debts, which is 200, and then the trade and debtors figure, that is what 6,000. Trade debtors figure 6,000. That's the only two figures that you need from the trial balance. The rest, let's go to the footnote. I believe you've done that, right? Now let's go to the footnote. So the footnote 2, you need the note 4. The note 4. Go. The note 4. The note 4. Good, it's 800,000. Great. Okay, so now let's do it together. Just at this time around. Now, still, I just have to clean the issue. The template is what they say. So just have to clean these sections, clean these ones, clean these ones, and then I'll go to the question. So first, in the trial balance, the open balance is what? 200 for the that of the provision. The open balance is 200. So the open balance is 200. Good. So 200. Then you record the 200 there. So let's see. 200. That's great. I don't know. So that is the open balance. Then what to do again? I record my closing balance. I'll go to the trial balance and see. And then check the footnotes. If there are notes there, yes. Note 4. Note 4 said that a debt of 0.8 million. Now here don't forget your currency and raise three zeros. A debt of 0.8 million. So in a trial balance, realize that if raising three zeros here, the currency too have to raise three zeros. Over here too, so the cities will be in three zeros. 1, 2, 3. Everything 1, 2, 3. In that order. So a debt of 0.8 million must be written off. So what's the total trade receivable on the trial balance? It was 6,000, right? So if it's 6,000, I'm writing off a debt. So you can record that one in the trade receivable. You can record that one in the trade receivable, or you can do workings. Any of them is correct. So let us know you're doing it on the face, on the financial position. I record 6,000 here, less the 200, right? But normally, if you do it here to give you clear picture, but you'll be fine. That's the first thing. I've written it up by subtracting it. Then I write it in the operating expenses as bad debt rating of 200. But the figure is 0.8, so it must be what? 800. Good. It must be 800. And then that is it. It must be 800 because 0.8 million and it's raising three zeros already. So we subtract 800 from the debtors figure and then you place that for us as an expense. You are done. Then what do you do again? Then what do you do again? Two, we now go and find for our what? Our provision, the closing balance of the provision. So the closing balance of the provision will be the closing balance of the provision. What was the percentage? Note 4. Okay, so adjusted to 5% of trade receivable. So here the closing balance, just find 5% of trade receivable. So now it will no longer be 6,000. That's the bottom line. It will be what? 5,200. The remaining balance. So times 5,200. And that will give us good. So here will be 260. You are done. So when you get to 260, you find the difference, the movement. You can go to P and then preferably the operating expenses. Operating expenses. Good. And then therefore you get to 60. Good. That is it. Then this is the workings. Then translate it into the financial statement. Don't go to the P&L. I record what? 60 here. Then I'll come and then subtract the closing balance from the receivable. So let me go continue again. Let me subtract 260 again. Finally, whatever I get, I'll place it here and it ends the game. So here I'll get something like 4940, and that's the end of the game. Yet increase in what? Provision. And all increase in provision they are expense. So that's why I see them here. Increase in provisions are expense. So it has increased by 60 or increased to 260. Good. So that is it. Now on that note, we are done with bad debt, but you have not done with bad debt. You have to try the remaining ones. So the remaining ones are you try the question 2 and question 1. So 2 and 1 definitely will be some inside. So this question 2, it's well. It's well. So it's well limited. Let's see if they are bad and doubtful debt provision. So here's the provision for bad and doubtful debt. That is 3,000. Cool. So let's go to the notes. Which of the notes? Notes. Notes 8. So note 8 states that the bad and doubtful debt provision is to be reduced by, and this is how I made it by capital letter. Yes, because very important. 12% of debtors. So you take 12% of debtors. So the 12% of the debtors. What's the debtors figure? What's the debtors figure? Debtors figure is receivable. Debtors is no debt. This is the trade payable. Debtors figure or trade receivable. This missing trade receivable. Okay, yes, so that is it. So 13,500. So 12% of this, and then you are done. Yes, the P&L is the bag there. This one, good. So the one that will go to the P&L is the buy. That is this figure will go to the P&L. Great. So that is the end of the first game. So I'm done with the adjustment. We are done with the accruals, prepayment, and bad debts and provision for bad debts. So the rest are what? Question solving. The rest are question solving. The rest are question solving. Good. The rest are question solving. Good. The rest are question solving. So let's continue. So question one is yours. So what we do is, so question three. Now, okay, I read there. Question one is yours. You are just trying the bad debt section. When you are done, I believe strongly that question one and two, we solve it without a footnote and it has balance. So as and when you are done, adjust the the financial statement. Especially for question three, we have balanced it before without the footnotes. So that means the operating expenses, we are going to add these two figures to it. Then operating expenses will change. In the bad debt to in the trade receivable to it will change to this. No longer be 5,200. And then prepare the new financial statement. It must balance. Good. Now, so that's what we'll be doing. In fact, for question number three, we are done with two strong notes. We did the note two last week as the accruals and prepayment. So for question three, we are done with note two and note what? Note four. So we have to prepare the financial statement again with the effect of these two notes. So we're doing note by note, note by note. By the time you finish, we are done with it. So the last balancing figure is the draft financial statement. Good. And then you try question one and two for me. Then from then you jump. There's a question. Getting to the end of the notes, we call it work hard. That's the name of the question. Work hard. I think it's around question five or so. Question five. Good. It's work hard. This is the particular question. Question five. It's at the back of the handout. And you try that one also for me. That one you try it for me. So the note five. Say bad and doubtful debt provision is to be increased by what? 25% of debtors. Okay, you try that one for me. Okay. Now we are done with the first aspect. That is the adjustments. We are done with the adjustments. So that is it. Now let's go through the the next section. We said that there are three items that will form the footnote: adjustments, and then errors, and then the IFRS. Now let's look at the errors. Errors or mistakes. So number one, that's number two. That's errors. Okay. That is errors. Um, for errors, there are no principle. There are mistakes that they've committed. So what do you have to do? We have to know how to record the entry correct. Then what do? We you reverse it. So first, if they inform us, they will intentionally treat some of the transactions wrongly, and then they will inform you that this is the position, this is what they've done, and you know that that position is wrong. So what do? So first, in error, first identify the mistake or the affected area. That's the first thing. So the treatment will be one, reverse it. Just reverse the error. Reverse it. So if they have wrongly added, what do? You reverse by what? Subtracting it. If they have wrongly subtracted, what do? You reverse it by what? Adding back. So that's the first treatment. And two, do it right or make the correct entry. Make the correct entry. So the correct entry must be made. So correct entry. Enter the correct entry. Good. So now cite a critical example for you. A critical example. Now a critical example will be critical example of what? Error will be. We all know dividend. How do you treat dividend? Coming from the last studies. Dividend. How do you treat dividend? Good. Dividend must be deducted from where? Retained earnings. Now let's look at this note. Let's go to question 2. Question number 2. One of the notes. I need only the first sentence. So let's go there. Just the first sentence. You don't need the second one. So question 2. So this is question 2. That is the it's well. It's well limited. One of the notes. Now let's go to note 7. I just need the first sentence where the first full stop is. That's all. It says operating expenses include, they've added an equity dividend of 12 million paid during the year. Is that the right treatment? If you pay dividend, do you record in operating expenses? Not at all. So it's an error, right? Wow, so you've identified it. So what do? First, reverse it and do the right thing. So something like this, what is the error? They've added it where? The operating expenses. So first reverse it. So they have wrongly added. So you reverse it by doing what? Subtracting it from where? Operating expenses. That's the first. Second, what is the correct entry? What is the correct entry? Or enter the right entry. So the correct entry will be or the right entry. So the right entry will be then subtract it from where? From the retained earnings. That's the right entry. So you are done. So that is errors. For errors, we cannot do all. Because the examiner can cite any mistake that you feel like bringing or like any practical words and common mistakes. They are very common. Good. Because you might thought that, oh, operating expenses, dividend, we've paid it, so it is an expense to us, so it must be added to operating expense. No. So that is it. Good. So here it means that you should know how to treat most of the items or correct before we can determine that this entry is wrong or right. So that is it. So we are done with errors. So any of the treatments, good. Now we are moving on to the third item that will affect the financial statement preparation, and it's the main challenge. That's the IFRSs, the financial reporting standards. That's the main word challenge, the financial reporting standard. Good. Financial reporting standard. That is the main challenge. So we will take our time and go through the financial reporting standard, the relevant ones that we need to be able to prepare a basic financial statement. We go through those ones, then we are done. Good. So we will start with the first set of the standards, and then that is the IAS 2. For the standards, we've gone through how the standards are set, what they are, and then some few issues about them. Please, if you have not gone through the conceptual and regulatory framework and the previous ones, kindly do so that you be what up to date, so that these ones will also be what okay. Good. So the third note, I can assure you that majority of the notes are standards. Yes, majority of the footnote will be what standards, and then they are the ones that we are going to what look for. So the majority of the notes will be what standards. Now let's see. So our first standard on the list is IAS 2. First we have IAS 1 that talks about preparation and presentation of financial statements. And that is what we are doing. So that one we've already started. So what we do is this. We will go down with the financial statement preparation and continue with the standards. So when you pick a standards, we will treat it and see how they will ask you the question in the final account and how you're going to respond to it. So that's the section that we have what reached. So from there, I'll go to IAS 2, IAS 10, and then IAS 12. These are the first three standards. Today, we are going to land ourselves on what IAS 2. Then next week, we will clear these two in that order, standard by standard. By the issue is this, they will ask you the standard on its own, preferably at question number 2 for 20 marks, and then you meet a standard in the final account as a footnote. So that means this standard are going to meet you 2 times. Good. So when we finish the standard, one, you should be able to know how to solve it theoretically. That's the question number one. Two, and how to apply it in the financial statement preparation. Now that's the main central focus, how to apply them. So when you read it, how would the financial statement will be adjusted, the extract. So that is it. So that is the game, and then the agenda. Okay. Okay. Now let's start with the IST. Now IST talks about inventory. IAS2. We call it accounting for inventory. So inventories. The inventories that we saw, or we call them stocks, they are the one that we are going to look at for. So, how do you account for the inventory? Now, if you pick any standard that you are learning, there's a central focus that you have to go there and learn that one. If you understand that section, in fact, they are great. It's like someone writing a report to you, a financial report. There's some money that they have to share, and then they've like write a whole like 3 sentence report, no 3 pages report. What you are interested in is what is the money sharing section. So he goes there, go and pick the samples from there, then you are done. The rest is the formality. The same thing applies to the standards. So every standard, I have grouped them to five critical issues, but only two to three of them that you need. The rest, don't even worry yourself. You should know it for your own good, for your own explanation. First, if you pick every standard, you should know one, the objective of that standard, and the scope. Scope means the coverage. Does it cover all the items? Good. So that is it. Now, two, you should know basic definition of some terms. Basic definition of some terms. Then three, recognition. Recognition. We've explained recognition under what? Conceptual framework. So we have not gone through a gentle reminder. Then the fourth one is what? Measurement. Finally, tell us any issue that's a disclosure requirement. So if you pick any standard that you are learning or any financial reporting standard, I understand some of us are not, in fact, we are allergic to the financial reporting standard. No, like it and then love it because once you are learning financial reporting, it comes with it. Good. It comes with it. It's like a lawyer who don't know the laws. You cannot argue your point with any supported case or any supported what article. Good. Now, it's not all aspect that you have to focus on. Only two to three. These three aspects, they are the section that they are important. The first and then the last one, they are not relevant. No examiner will ask you. Now, objective and scope. In fact, objective of every standard are the same. Why? The objective is to prescribe the correct accounting treatment of that standard. So if you know the name of the standard, you should know the objective. It's a template that you have to put the name there. How we get it? So to be what's the objective of IS2? Once the IS2 talks about inventory, definitely the objective is what? To prescribe correct accounting treatment of what? Inventory. You are done. That is it. That is the objective. Now, the rule says anywhere the examiner quotes the standard IS, you have to name it. Likewise, the student, the same thing. Both students and examiners, if you quote the standard, name it. You can't quote IS2 and then leave it blank like that. No. So if you don't know the name, don't quote. Don't quote at all. So it means that if an examiner will solve the question for you, so if I ask you, what is the objective of IS2 inventories? Then I've solved it. So just tell me that it's to prescribe the correct account treatment of what? Of inventory. So that's why that's the main reason that no examiner will ask you. And what about the scope? The scope talks about the coverage. Does it cover all inventory or there's exceptions? Or there are exceptions to this? Now there's a general rule. No, the rule is like this. Example of inventory. Inventory is what you buy and sell, what you do in your trading stock. Let's assume that we are farmers. We are farmers. We produce cocoa. We have some cocoa beans there that we've not sold, and then it's there. So it's an inventory because that's what we do. We sell. That's what we do. We produce it and then sell it. That is what we did. So that's our inventory. But cocoa, cocoa beans, there was a special standard for cocoa beans. We call it agriculture asset or biological asset. That is IAS 41. So there's a great standard or a bigger standard that talks about agricultural produce or biological asset, which is IAS 41. So you mention it here as an example. Your requirement cannot what control or covers it. This one is a general exception. So anytime it's being covered in other standard, that standard have control, not here. So inventory, it will comprise of all inventory except those covered in what? Other standard. That's the general rule. Example, if you have, let's say, you deal with you deal with these items, mineral consumption, gold, they are inventory, but there's a particular standard that talks about gold and minerals. So that means the requirement of RS2 will not what? Cover it. In fact, this one is happening everywhere. Let's assume that uh, river, if river want to join sea, can it join straight? It must what? Salute and pass through the edges, right? Good. So if you are strong and then you're only strong in your duration, the other one will not cover you. That is it. Even sea, their demarcation, ocean, their demarcation. Yes, there are separation between them, or there are like boundaries between the ocean and sea. So ocean, sea, gulf, even they are what different. Even though all of them are what water body, large water bodies. For some of them are together, ocean and sea, and then the gulf. Good. So history of the day, you tell me the difference between these three. History of the day. Yes, there are difference between sea, ocean, and what? Gulf. But Ghana, we sit on the Gulf of Guinea, right? Good. So what's the difference between the Gulf of Guinea and then the ocean versus the sea that we have? Good. So that is it. Now let's continue. So I'm done with the scope. No examiner will ask you, and then the objective. But you know it for your own good. These three items are the important ones. Maybe the standard, they've defined certain terms in it. You have to familiar yourself with it because the examiner can ask you to define it for us. So let's see the basic definition in these standards. Here I'll start with the inventory. So we define inventory for now. The rest you see them. So let's start. Inventory. When I'm done with the definition of inventory, I'll pick what? Recognition, measurement, and then we are done. Good. Now, what are inventories? So what are inventories? Definition of inventories. What are inventories? What are inventories? Good. Now we are saying inventories are assets. They are what? Assets made up of. So inventories are assets made up of the following: one, two, three, four. Good. So inventories are what? Assets made up of one, raw materials. Raw materials. Two, work in progress. Work in progress. Work in progress. That's the partly finished goods, semi-finished goods. Three, finished goods. Finished goods. Then four, Consumables. Consumables, that's production supply, like components. You can call it major component or spare parts. So let's start with raw material. If you produce products and then the raw materials that you've acquired, they should form part of your inventory, your stocks. Yes, they should form part. So if you produce, let's say, um, we manufacture some pastries. So our main raw material be what? Flour and other ingredients. So at the end of the year, if there are some of the flour there that we've not used, it should form part of what? Our stocks. Good. So that's the raw material. Work in progress, partly finished. At the end of the reporting period, some of the products are still in process. They are still in the production process. So that is it. Then the finished goods. The finished goods, they are the ones that which are in our warehouse. That we store them, or they are in the shop. That's the store. Or they are in what? The distribution outlet. Outlet. So the finished goods, they are the one that are for sale. They are the one that's in the warehouse, and then the one that's maybe in the outlets, our agents. That's the finished goods. Then consumables, parts, major components or spare parts. Good. All of these form part of what? The inventory. Let's assume that we produce car, we manufacture car. Some of the assets they are complex to the extent that we cannot manufacture everything of it. We manufacture up to certain point, go and buy some part, come and fix it and sell. So Toyota will manufacture their car and go and buy car tape from where? Sony, and come and fix it and I'll sell the car. So this car tape, car batteries, this car tires, sometimes made by a different company. Good. Even take the PC that we use at our office or any PC at all. The PC is made by a different person. The software is also made by a different person. In fact, the how do you call it? The board, the processor is even made by some different person. Intel, so HP or Dell or Acer will go and buy Intel processor, come and put it in their device. Why is that they don't manufacture the processor by themselves? If I see a laptop that the processor is being made by HP, I'll not buy. Why? Because they are not into manufacture processors. So they have to go and then give to someone else. It's like you are producing book in Ghana, you are making your own paper to produce the book. I'll not buy that book. Why? But exactly because you're not into manufacture a paper. You are there to just produce the book. So go and buy the paper somewhere, come and then unless. But the issue is this: why is that Apple when Apple manufactured their nose marks, people were buying it? Good. That's the brand name. The quality is there, right? Good. So that is that. So we are done with the definition for inventory. So the closing inventory that you see in the financial statement must sum up all this together and you get the closing inventory. I am done. So have you seen the standard? It's not something which is what too abstract. No, not at all. So in exams, at the elementary level, manufacturing accounts, we can list this item for you. Okay, raw material, the value is 300. This one is 200. And this one too is 100. What is the closing inventory? That is what? 600. That is it. So the closing inventory is 600. Not only the finished goods, which is 200. No, that is it. Now let's go to the game. The the recognition. Very important. We explain recognition at the conceptual framework that recognition simple means recording of the transaction, reflecting the transaction in the books. So how do you record inventory in the books? That is the recognition. So how do you record inventory in the book? So recognition. Recognition simply means how do you reflect inventory? What is the treatment? How do you record inventory in your books? Good. Inventory must be recorded as what? As an asset. Now, here there are two issues here that we have to look out for. Inventory. Inventory play two roles. The recording of inventory is being guided by the accrual concept or the matching concept. Good. So sometimes there are three types of inventory because we have the unsold inventory and what? Sold inventory. Good. So unsold and sold inventory. Unsold inventory is what? Is the closing inventory. So what's the treatment of closing inventory in the current period? And then next year, when they dispose it of, what's the treatment? Good. So unsold inventory, that one is an asset. That one is what? An asset. It's an asset to us. So unsold inventory, in short, it must be recorded as what? Asset. Preferably current assets. That's why inventory is in the current asset. It must be what? Current asset. So if they are left over inventory that you did not dispose them of, they must form part of your what? Your current asset. How do you get it? Good. What about the sold? Why is it a current asset? It's being guided by accrual or matching concept. We said that matching stays if you want to determine the year's revenue. All revenue one side, match it against what? All expenses. This inventory, have you disposed it of? No. It's unsold, right? Okay, if it's unsold, then let me push it forward to next year because I will sell it next year so that when I go there and sell it, I will match it there. So that's why we are recording it on the financial statement, the balance sheet, so that we can carry it forward. So all what you have to assume is that closing inventories are what? Assets. That is the unsold inventory. So unsold inventory is called what? The closing inventory. Closing inventory. And they are what? Current assets. Good. So in short, unsold inventory or the closing inventory, they are what? Current as assets. We are done. Now let's go to sold inventory. Maybe this inventory that is left over today, tomorrow, we are going to sell it. So when you dispose it of, how do you treat it? Now they are what? Sold inventory. And they are what? The open inventory. And open inventories are what? They are expense in the P&L. It must be expense. That's why in the cost of sales calculation, how did we state it? Last week, we look at the cost of sales calculation, the composition of the cost of sales. Who can tell me? Good. Now, cost of sales calculation will be like this. Cost of sales. Cost of sales is what? Open inventory. So much. Add what? Purchases. So much. Less what? Closing inventory. Good. Now, this open we are adding. That's why we are extending it. So open inventory must be added to cost of sale because an expense is a cost. It's an expense to you. But the closing inventory is not an expense, it's an asset. So that's why we are subtracting it from the expenses and sending it to the financial position as what? As an asset. So that next year when we sell it, then we reverse it and bring it as what? As open inventory. Then it become an expense. How do you get it? So, in short, inventory, the treatment of inventory is that it depends on the state. If I've disposed it off, then it's an expense. If it's if it's still there with you, it's an asset. We are done. That's the treatment. Now the examiner can ask you, during the year, Mr. So and so sold some of the inventory brought forward, sold it for 10,000 Ghana cedis. Tell Mr. So and so how we should record it. Oh, Mr. So and so, you sold the inventory during the year. Relax. You sold it, eh? Good. So the cost of the inventory that you dispose of must be treated as what? As an expense in the cost of sales. So you have to add it as what? As open inventory, Mister. That is it. You are done. Okay, another time, Mr. A had some closing inventory of 20,000 and he's confused. You don't know how to treat it. He thought he had money. So he ran to you. You are a financial reporting expert. So what are you going to tell him? Oh, Mr. AB, relax. It's a closing inventory, right? If you not sold it, don't worry. So that one is not expense to you. It's not again also to you. So, but it's what? It's an asset. So take it off from your expenses. It's not expense. So take it off. This is expense. So take it from the expenses and go and send it to where? The financial position as what? Current assets. So that is it. So in short, inventory can be asset when they are what? Unsold. It can be expense when they are what? Sold. That is it. We are done with the recognition. This is all what you need for recognition. Recognition means how are you going to record it? The recording of inventory, that is what? Recognition. That is the recording of what? Inventory. So inventory must be recorded as an asset if they are what? Unsold. Inventory must be recorded as what? Expense if they are what? Sold. That's all. No, the cost of what you have disposed it of, not the amount that you have received. We are talking about the cost of what you dispose of, not what you are receiving. What you've received there to be part of the sales, but you're talking about the value. Maybe it cost me 1,000 Ghana to obtain these two items. I sold it for 1,200. How do I record the 1,000? The amount that it cost me to obtain the goods, the cost of it. Then ask myself, okay, this 1,000 Ghana, have I disposed it of? Oh yes. Oh, then it must be what? Expense. If it is unsold, oh, then let me go to the financial position and record as what? As assets. So here we are talking about the cost of the inventory. So cost of sold inventory. Cost. So here we are talking about cost of unsold inventory. Cost of the sold. Because the sales, the proceed, the sales will be in where? Will be in the sales, in part of the sales, the revenue, or the turnover, or the net sales. But here, we are looking for the cost of it. Good. So that is it. In fact, the value is very important. How to obtain the value. Good. So I'm done with recognition. So next time, when the examiner asks you, how do you record inventory? Tell him that I said, inventory, if they are disposed of, they are what? If they are disposed, yes, yes, good. But if they are unsold, good. So leftover inventories are what? They are current assets. Yes. So this remind me, measurements. Please the standard like it. And then define. Let's go to measurements. We are done with recognition. In fact, if you don't understand anything, not the measurements, but that's where the examiner is going to worry you. Measurements. Now, we learned at the conceptual framework that measurement simple means what? The value. How to obtain the value. So measurement of inventory. So now we're on the measurement, the last aspect of inventory that we are done. Measurement, that's all. We learned that measurement means value, how to obtain the value. Now we've learned how to record inventory. Now we are going to learn how to obtain what? The value of inventory. Have you seen they are twins? Oh, have you seen they are twins? Good. So now if you know how to treat it, at least you know how to what? Get a value too. Because the truth of the matter is that if you know how to treat it and the value is wrong, forget it. It's a value. Even if the value is correct and the treatment is wrong, at least we might consider as what workings or text for you. Good. Now, the measurement tool, there are two types, or the value of inventory tool, there are two types. So we have what you call initial measurement and what? Subsequent measurement. And this you're going to read it three times. Initial measurement and what? Subsequent measurement. Subsequent measurement. Now, as soon as we are done with these two, we are done with the IS2. That's the end of the game. So I'll start with the initial measurement. If you don't understand anything today, not the measurements, what I'm going to do, because they are very important. Good. Now, initial measurement simple means when you acquire the goods, the inventory today, what is the value do you have to key it in? Initial. So you bought the goods January. What will be the value? Subsequent measurement simple means the next reporting period after the acquisition, after you acquire the goods, the next reporting period, maybe December, what will be the value? That's what we mean by what? Subsequent measurement. What will be the value after the next reporting period and the next reporting period and the next, subsequent, until we dispose of the inventory from the books. Good. But now we are looking at what? Initial measurement. We also call it initial recognition. That's the nickname. So initial measurement. So initial value. So let's assume that we deal with rice. Yes. We buy rice at the wholesale joint and then come and then retail it to the market women. We buy it at a large stock. So we bought some rice from rice masters. In fact, we even import rice. We import rice to the country from Rice Master or Uncle Sam or Lily. And sometimes you can even buy from the local farmers and process it and sell it. So we bought Uncle Sam. Let us now we have shipped 50,000 bags of rice into the country. 50,000 bags of rice. Initially, what will be the value of these 50,000? Now we are saying that all initial measurement is at cost. So initially measure them at what? Cost. So the underlying word is what? Initially, inventory must be measured at what? At cost. So initially, inventory. So these 50,000 bags of rice must be measured at what? At their cost price. How is it? So initially, inventory must be measured at what? At cost. So initially, inventory must be measured or valued at what? At cost. Full stop. You are done. Initially, inventory must be measured at cost. In fact, if you get this one, you are fine. Now, it means that 50,000 bags of rice that we have imported into the country to sell, we have to find the cost of these 50,000 bags of rice. And that's the initial value. Yes, ideally, if you go and buy calculators for sale, oh, the initial value is how much you get to acquire the calculators. You are done. This one is practical.
If you go and buy something to sell, the initial value must be the amount that you will spend to acquire the items. That is it. That, in fact, when you say cost, let me even make it capital. So I know that is very important. I'll go and line it. Now, this cost, when we bought the 50,000 bags of rice, we incur a lot of cost, a lot of expenses. Are you going to record all of them? Are you going to include all of them in the cost calculation? You have to exclude them. So that the standard permits certain cost. Standard do not permit what? Certain cost. That is it. The standard permits that certain cost to be part and certain cost not be what? Be part. So now let's take our time and go through the standard that should be part of what? The item that should be part of what? The cost of the inventory. So we call it inclusion or the composition of what? Cost of inventory. So that's our next subtopic. Composition of what? Cost of inventory. Because initial measurement is at what? Is at cost. So let's read here. Composition or component. So component of what? Cost of inventory. Please, you are going to read this one 3 times. 3 times before we finish. 3 of the standards will tell you cost. So if you understand it here, when we get there, it will be so clear for you. So it will come like 3 times, and it's the same 3 times. So let's try and understand this one. We move to the next stage, it will change a bit. Next stage, but the same. The principle is the same. So it means that you will incur a whole lot of cost. Not all of them you'll be allowed to what? To include. So the component of cost of inventory, they are, in fact, we have a lot of items and then their cost. Here we are considering what? Inventory. Good. So that's why I mentioned inventory. In fact, it's made up of 3 items. Add them, you are done. The purchase cost. Purchase what? Cost. Now, when I mention purchase cost, it's a family. It also have a sub cost. Yes. Purchase cost include one, the purchase price itself. So it include the following. Example of purchase costs are one, the purchase price itself. We normally call it the listed price, the quotation price, or the base price, the wholesaler's price, the manufacturer's price. They inform you that the price is what? Is $2,000 for the 50 bags of rice. Okay, fine. Or $50,000 for the 50,000 bags of rice. That's it. Then that is the base price. That's the purchase price. Or when you buy these goods, are you going to sell it at where you bought it? No, you have to bring it to your what? To your shop. So transportation or delivery or handling. Sometimes some of the inventory, they are so precious that even before you transport them, you have to even start preserving them on the way. Yes. Let us assume that you were exporting fish from one country to the other. That means the delivery process must include what? Cold rooms or facilities that can preserve the fish on transit before you come and then put them in your in your cold room or cold store. How we get it? So all of them form part of what? The cost, the purchase cost. So you call it delivery or handling cost. Then it also includes import duties. Import what? Duties. Import duties. And it includes what? Irrecoverable purchase taxes. Maybe you pay tax on these goods. You paid VAT. Here we are being practical. You paid VAT on these bags of rice. Yes, you pay VAT on them. Now, the standard is saying that the taxes that you are allowed to add must be the tax that you cannot recover them. Some of the tax you can recover them. Pay now, like VAT. VAT can be recovered. That's why you can pass it on to the final consumer. Good. So here you are saying it must include what? Irrecoverable purchase taxes. So irrecoverable purchase taxes. Or in short, it must include what? Taxes. They are one that you are not going to recover. If you know that this tax that you are paying today, you can claim it back at the tax authority, please do not include it. Less trade discount or similar rebate. We are done. Less trade discount or similar rebate. So that's the end of the purchase cost. Don't forget the costs are three in number. Purchase cost, then directly attributable cost. So let's go to the second type of cost. All these ones form under purchase cost. They are not on their own. They form under purchase cost. So they are the examples of purchase cost. Please, one question will not have all these items, not at all. And if we are not done listing all of them, this one like inclusion. So they can cite any example. So these ones are the best one that they may set. Good. Now the second one. Now the second one. That is what? Because directly attributable cost. Directly what? Attributable cost. Directly attributable cost. Now these are direct labor and overheads. In short, they are what? Direct labor and overheads or direct expenses incurred on the asset. Now, if you're able to purchase the goods and we brought the goods into our warehouse, sometimes these goods we have to work on them before we sell them. Some of the goods they are not like, in fact, only few goods that when you buy them, you don't need to work on them, just straight away you sell it. This rice, let us assume that we are selling to we are a retailer. We import it bulk, store it, now break the sack, pour it small small, margarine into margarine sacks or the olonga and what again. So all this one may incur additional cost after buying. So after buying it does not end there. After buying it does not end there. If you buy and sell, let's say, accident cars, all what we do is we buy and sell accident cars. Let us be practical. These accident cars, when they come, maybe the gate is what is it the gate? The door or the some part has been broken or removed. We go and buy and fix it and make the car ready. Then we sell the car at higher amount. All this fixing of this part or broken parts, they will be what? Directly attributable cost. They are the direct labor. So if you buy the goods, if you bring the goods in and you have to do some work on them, any cost that you incur must be part of it. Good. Example include what? Site preparation. Some of the goods you have to put them at very good place. That is it. Then you can also add the production cost. Let us know that we are manufacturer. If you are a manufacturer, you go and buy the raw material, come and produce them. So manufacturer, so manufacturing cost will be part, manufacturing or production cost. Yeah, underline word is what? Production or manufacturing. Underline word is what? Production or manufacturing. Whether fixed manufacturing cost, whether variable, it must be in. Fixed cost. And here we have to apportion them based on the unit produced. Good. So that is it. Then the last one is any other cost. Any other cost you incur necessary to bring the asset to its what present condition or location. So any other cost that you incur to make the asset ready for its intended sale. You sell item, maybe you are selling tilapia. You buy the tilapia bulk, store them. When you are done, take this tilapia, work on them before you sell them. Maybe when you buy the first tilapia, when you come, you have to now remove the scales, dress it before finally you sell it. So any other cost that you incur on this inventory before you can sell them, it must be what? Added to the cost. We are done. Now, the issue is this. Once there are inclusion, there must also be what? Exclusion. Some of the costs, when you incur them, please do not add it. We call it what? Exclusion from the cost of the inventory. So let's do that one on the other hand. So I'll do that one small here. Exclusion from the cost of inventory. These costs, when you see them, please, exclusion does not mean go and what? Subtract. No. In that, do not touch it. Don't add it to what? Um, if they have mistakenly added, what do? You reverse it. Item number one, general and admin costs should not be part. Administrative overhead and general expenses should not be part. So admin and general overhead should not be part. Good. Two, selling and distribution cost should not be part. Selling and distribution cost should not be part. So the selling cost of these goods should not be part. Like the marketing cost, it shouldn't be part of the cost of the goods, not at all. The third one is what? Storage cost of what? Finished goods. Storage cost of what? Finished goods. Good. So that is it. Now, let's try and then go through some of the questions. So I'll project some of the questions and then you try for me. So that is it. So on the screen, you will see some questions. Kindly be with us and then let's try to determine the cost. When I'm done, I'll walk through one question from your exams past questions for us to try it. Good. So example 2, Emmet Company. The Emmet Company has a cost card in relation to the item of goods manufactured as follows. Material 70, storage cost of finished goods 18, delivery to customers 4, irrecoverable purchase taxes 6. According to IS2 required inventory, at what figure should the item be valued in inventory? What's the value of this inventory? Start work. Good. So now let's try it together. So first, material. Yes, it should be parts. So 70. Second, storage cost of finished goods. No, it should not be parts. Thank God. Delivery to customers. Should it be parts? No. Delivery to customers will not be part. Here, let's go back to the board. Now we said that the delivery, it must be when you buy or you acquire the goods, the amount that costs you to deliver the goods to your premises, not when you are what? Sending the goods to what? To customers. So that will not be part. Delivery to customers are carried out to us. There are promotions or adoya that you are doing to your customer. that you are sending the goods to them, paying their, it's a marketing strategy and it's a marketing cost or selling a distribution cost. But you, when we bought the goods, any cost incurred, transferring the goods to your warehouse or to your shop or to your premises, that is the delivery cost that we are talking about. I'll be getting. So not any delivery cost at all is the one that you have incurred to bring the goods to their present condition or location. Good. Because this cost must be directly attributable to the goods. Good. So that one will not be part. Then irrecoverable purchase taxes. Irrecoverable purchase taxes, that one will be part. So therefore, in total, we have 76 to be the final answer. So 76 will be what? The cost of these goods. We are done. Now let's move on to the illustration 2. S&M company produces unit of product UB06. The following costs have been incurred. Direct material and labor 1.8. Variable production overhead 0.25. Factory administrative cost 0.15. Fixed production cost 0.20 required. Under IS2, what is the correct inventory value of a unit of what? Product UB06. So here too, as usual, let's try. Let's try. Put some few figures together for me. Just put them together. Let's put them together. Let's try. Let's try. Okay, first answer received. Okay, great. Any answer for me, friends online? Now let's continue the game. So first, direct material and labor will it be part? Yes, it will be part. So that's 1.8. Then variable production overhead to be part. That's production 0.25. Then factory admin cost will be part. Exclusion. Once there's admin, it should not be part. Fixed production cost will it be part? Yes, because there's what? Production. And the other one is what is production. Don't say that because it's fixed cost, no be part. No. It's what? Production. So therefore we get what? 2.25 to be the final answer. You are done. I'll be get it. Good. Now let's go to the last one. The last one that you do it for me. When you're done, then we sign off. The last one. That's Woso Woso. Woso Woso company is a manufacturing company. Cost per unit of an item of inventory is shown on its card as follows. Material, they are there. So tell me the total cost. Then we are done. Then I think tomorrow or Sunday, the drop that I'll bring, the drops, I'll make sure that it will contain one of your exam question on inventory. Please try the drops. They are very good for your health. I'm not a doctor and I don't know the kind of nutrient that it contains or the antidotes. It's very good, is it? Okay. It contains, it's a good supplement. Good. So that is it. But they are very good. They're extremely good. The drops. Great. I have two answers here. 75. Great. So I think that would be a great answer. How do you get a 75? Material cost will be parts. So 30, let me put it down. 30. Then production labor cost. One is production. I'll add 33 plus production overhead. In fact, one is production. What matters is production plus 12. Then general administrative costs, not at all. And then marketing costs. That's all. So we are done. Now the issue is this. Let me do something here very important. Now the exclusion cost, why are you going to treat it? It must be straight from the cost. It must be what? Expense in a P&L. So all the exclusion costs must form part of what? The operating expenses. All the exclusion, in fact, the exclusion, the third one is the storage cost. Let me add one to it. The fourth one is losses, production losses, losses. All these must go towards the operating expenses in a P&L. Because sometimes we ask you to account, tell us the treatment. So if you are not adding it to the cost, then why are you going to treat it? Tell us. So that's what we are saying. Good. So that is it. So that's the end of initial measurement. We are done with initial measurement. What level is the subsequent measurement? Just that unfortunately for us, this is how far the good Lord will bring us. So if you do have any question, can you let me know? Any suggestion, any contribution, can you let me know? Good.